Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Hey, sorry, I got this sound on my machine all screwed up here a little bit. Oh, hold on, just one moment. I think I plugged something in wrong. I unplugged a sound device. Yeah, that's wrong. That's wrong right there. Okay, so let's just switch these two here. Audio. And do that one and that one. And now, yeah, you shouldn't hear that. Now, we'll see if you can hear that. But, oh yeah, and then also, let's get some tunes. Well, let's just start with ambient here. All right, so anyways, yeah, I thought that today was, or this week in general, might be like difficult and quiet, but the treasuries are starting out with a pretty strong trend. Perhaps because of some of the fallout from bad numbers in China. I don't know. I don't really see a clear catalyst. Let's just come over here to the charts and check out the what we got here first. Okay, so you know, was kind of difficult trading on Friday. Didn't really go much of anywhere. And of course, remember that we had some of these where it was like, oh yeah, like buy the bonds. Oh no, the Federal Reserve actually they don't want us to buy the bonds. And now they're pushing back again. Equities doing okay though. Oil taking the hat, getting hit. Ouch, 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 ouch. Well, that's interesting though, because typically when we see oil go up and the treasuries, oh, okay, no, oil going down and then we could see the treasuries going up. It could be oil. It could be oil, or at least a factor. Oh man, like gold and silver were looking okay above 1800 until this latest move here in the yields. So that's really, man, it is gonna throw a wrench in the day of many a trader, isn't it? I'm not feeling this tune, dude. I am not feeling this tune. Okay. Anyways, the dollar. I have to adjust some of my monitors here too. The dollar. Oh no, this is Bitcoin. Bitcoin is still holding 2,400. But the dollar looking strong here this morning and pushing 106 again. So I'm gonna come over here. Oh man. Okay, so a couple of things I got to do here. All right. I recorded a video and I kind of will move my monitors a little bit to make the scene look better behind me. And I don't think I got them all back into the right spots. I think that's a little bit better. There we go. I don't know what happened to me this morning because I just I got everything set up in here. I'm like, okay, now we're fine. Although we're not quite fine. Here, hold on. That's a little bit better. Like I fixed everything, and then it was like, oh, it's time to start. I think something big would have to change to push the yen below 119.06. Look at that. Look at what happened. What happened? What I miss? Oh, whoa, holy shnikes. I'm looking at the chart now. I'm like, oh, okay. Well, we got some news coming. We got New York Fed manufacturing. Let's see what that does. All right. Might. Oh shit. Wait, what? That number can't be right. New York. Okay, New York Fed manufacturing negative 31.3 versus an expected 5. Are you kidding me? Okay, so this move up in the treasuries must have been them following that New York Fed number. I'm gonna leave it alone and let it settle. I mean, it is a Monday, man, and I'm just not ready for it. Otherwise it would have looked like a really great trade, right? But they front run that so much that I got to be a little bit weary about just trying to run with it here. But how is that even negative 31.3? Holy cow! Oh man! Wow. So I'm just thinking out loud here, but you know, going into the week, I was thinking, well, there's not too many huge numbers this week. We do get like housing numbers and stuff. Still some bill auctions and stuff. Still going to get Fed speakers, of course. But, you know, probably the dominant factor is that we got options expiration at the end of the week. So I was thinking, you know, maybe that's going to be dominate for us, right? And then I sit down. Huge move up, and then this New York Fed manufacturing number is just dismal. Now, it might be that specific area because, again, the strong dollar is really been hampering U.S. exports. And so I'm going to guess that that's why it's so bad. But it being that bad is pretty rough. You know, I've been seeing this thing where it seems to me like the U.S. has been... it wants the dollar to be stronger than it usually is right now. Like, it's really hurting China, right? They're putting on the lockdowns and all that sort of stuff. The Taiwan issue, it's really hurting. And then you clamp down on the dollar on top of that. Like, it's really been, and some have been wondering if some of it has been that, you know, but, you think she's going to want to gravitate to 120.24, not necessarily today, but throughout the week? Yeah, well, that was the area from before, but I don't know. It seems to me like there is just not the volume and the desire from investors out there to get the yields of, like, the 10-year above 2.8 or so, you know, like it being 2.8 here right now is pretty like, wow, okay, but they keep seeming to get dragged back down to 2.75. That's happened several times in the past few weeks, right? The Fed wants rates to rise, but the market is getting really skeptical that they can do it. And I was expecting, well, maybe after the options expiration, things could get a little bit more interesting and we might see a downturn. But now I'm sitting here like there could be some pain here before all the options expire. Oh, you know what? I don't know what the deal was, but when I put my room back together after filming this weekend, I did not get it all done. Hold on a second. Close this window. Maybe they're realizing Bitcoin is more safe. Oh, no. Listen. So coming back over here. Okay, we've seen a really big spike up here in rates. Okay, equity markets did not really notice. Okay, one has to wonder if the trade right now is to turn around and sell the S&P 500 because it's Monday and this already looks nasty to me on the bond side. Like the bonds are saying, look out, man, look out below. I'm a little bit worried about what the equities might do today. Okay, if the equities sell, okay, there's a lot of downside, and yeah, Bitcoin will probably get hammered as a risk asset. And they've kind of loaded up here. So if Bitcoin were to fall back down to 20,000, I think that would be pretty damaging here, right? I don't know. They could at the very least come back to the bottom end of the range if equity weakness comes in here. So I wouldn't be just piling into the Bitcoin trade. And unless you think that the Federal Reserve like eases off interest rate increases immediately and the S&P 500 rallies and yada yada yada, right? But Bitcoin has just not been the idea that Bitcoin is a safe haven is just absolutely contradicts everything that we've seen. There's no longer any evidence whatsoever to argue that Bitcoin is a safe haven asset of any kind. It is a risk asset. It is most correlated to the S&P 500. It's a risk asset, and you're getting beta out of it. So if we have another turn here south in the markets, I would be really careful about what I have in Bitcoin. Right, because not only do you have risk assets falling, but there's a lot of legal action going on against even Coinbase and stuff. So, you know, it could get really ugly if they continue to have a downturn. You know, the Fed is gonna burr. You know what though? Okay, here's another thing, Anthony. Y'all's been saying that for like a year and a half now, right? You remember at the beginning of the year when I was like, well, the Fed says that they're going to raise interest rates and they're going to raise interest rates really, really aggressively. And you're like, no, they can't do that because then the debt would be too expensive and all this, that, and the other things. And it was okay. Well, we went long interest rates and rode it, and a lot of people didn't. I don't know what to tell you. Oil taking a plop would probably have a ripple effect. Yeah, I think so. Seeing oil here, like, come on, look at oil in the past just week has been like, what? Coming into the chart. I mean, it's really volatile in general. Oil, right? It's been really volatile in general, but on Friday we were like at 94. Now we're at 87. Like, what? And if you come over to like oil on a daily chart, you know, we're basically to some of the prices that we were at before the whole Russia thing in oil. I mean, oil is kind of warning. You know, another one that we didn't look at this morning, as well, at least as deeply as we should have. Kappa. Look at copper getting hammered today. Like this market, every asset that I see, it's so weird because when I was looking at things on Sunday and I was reading my morning rundown of things and everything, I was kind of like, oh, okay, it might be a quiet week. I'm coming in this morning and it looks like the world's on fire. I don't see any like headlines, well, except for the New York Fed Manufacturing Index. That's pretty nasty, right? But I don't, am I missing a headline or something? This just looks like the market is just screaming risk off to me. Well, the Federal Reserve. So here's the thing. If we go into another downturn, or rather, there is a possibility that we are close to a turning point in interest rates where we are at the beginning of another cycle where they lower interest rates again. Okay, it's true. Okay, but if you're expecting it to turn into we lower interest rates and we just keep them low forever and print money forever sort of a thing, I think you're going to be disappointed, because the monetary environment that we have right now is just not the same as what it has been the last 10 years. So you got to understand that. Of course, there are still some of those generational kind of level deflationary pressures. Essentially, like aging population is a deflationary pressure. Yes, but other things like deglobalization, conflict with Russia, tension with China, oil supply being tight, and underinvestment in energy, the man, you know what's one that really wild is, I'm really kind of wondering, like it just like sends all of the conspiracy theory alarms off in my head, is it seems like every river in the world right now is low. It's like, yeah, okay, so I understand you could have like a hot year and you can have drought, but like, isn't it if you have drought in one area of the world that you should be having like floods in another area? Like, don't those things kind of, but no, it's like, we're really, really low here in the Western United States. They are low in Germany. They are low in China. That is an inflationary pressure. Okay, so we are in a inflationary environment, probably at least until 2024. So if we do have a cycle, I would not expect it to be that easy, right? They're going to do just enough to stabilize the markets, and then they're probably going to have to raise the rates back up again, because if they don't, inflation is just going to go wild and out of control again. So I would not expect them to just like it get super easy. Like in this situation right now in the economy, I would be extremely surprised to see any kind of rate decrease in the federal funds rate until mid 2023. If then, what's more likely to happen is they raise rates 50 basis points in September, and then if we really, really have a bad market in October, then maybe when we get to the November hike, they don't do anything, right? Maybe they just keep rates there at neutral for a long time. I could definitely see them keeping them at neutral for a long time. But I really don't think that we should expect things to get easy like they were. And the thing is that what's happening right now is with them raising the interest rates is all it's doing is taking the fluff out and showing you what the real situation is in the economy. And it exposes the problems for sure. But you lower the rates again, that doesn't fix those problems. Just keeps us afloat, right? And a lot of those problems are things that we don't really have a whole lot of ability to do anything about. what needs to happen, what I need to be seeing from lawmakers, from the president, etc., is addressing some of the more fundamental problems in our economy that we can address, right? Like, why is it that all of the manufacturing in the United States fleet abroad, right? Those are things that we can fix, and it'll take a lot of political willpower to do it. But it seems to me that the trend right now is towards deglobalization, and the United States has been the most interconnected, and therefore will have the most work to do towards making itself self-sufficient again. But that's going to be an opportunity for us if it happens. Yeah, you getting conspiracy theory. Listen, you make your investment strategy based on conspiracy theories, it usually doesn't work out for you. Don't base your trading off of political leanings. It never works out. Base it off of things that we know are going to predict future order flow, right? Deglobalization is a real thing, okay? It's definitely happening right now. So when it comes to Bitcoin, the next thing that we got to get thinking about, right, is that the SEC is investigating Coinbase for listing securities without registration. They're looking into Coinbase employees running coin offerings. There's all sorts of regulation and so forth. Like the industry saw what happened and is now kind of taking action after the fact, as is always the case with regulators. That's a real headwind to be careful about in Bitcoin. And then on the other side of that is that if we have another downturn in the markets, it's probably likely to follow that downturn in the markets. But if we do get another money printing bonanza or whatever, where S&P 500 rallies because of easy monetary policy, I would expect to see Bitcoin rise with it too. But if that is to happen, it's probably not for several months. I was told on Facebook friends that I'm a conspiracy theorist. In 2019, I started investing on my long-term speculation, so I'm not going to say it's not working out now. Why do you think the treasuries had a negative reaction to the numbers on Friday? I have to remember what we did on Friday. I have to spark my memory because I don't remember. Oh, you're talking about the what was it? The consumer sentiment numbers, right? Because I don't remember. I don't quite recall. I remember talking about it. I remember talking about it on Friday. It does seem like that we went lower after Michigan. But I don't know if that was strictly about the Michigan numbers. I think what's going on there more, Paul, is that the Federal Reserve has been saying that it's going to take more than just one CPI report that looks okay for us to back off raising interest rates. We really have to have a clear picture that inflation is behind us, because the tendency that you tend to have in interest rates and so forth is that you raise them a little bit, it seems like everything's fine, and then inflation comes roaring back, and you're like, oh, if we had just kept going, we would be fine. Right? So I'm not so sure that it was strictly because of the consumer sentiment numbers. Also, the consumer sentiment numbers, like the inflation expectations were a little bit mixed, and I'm not quite sure what to make of those. But the headline number was good. It was 55.1 versus 52.5. Okay, which suggests that the consumer is still doing pretty okay, and that's going to mean they raise interest rates and treasuries sell, right? So I think that that's largely what they were going in on that, right? I don't know. Like, the thing is that when we look at over the last year from 2021, this is one of those rare situations, I think. Is it really that rare? I don't know. To me, it seems like it doesn't turn out this way very often, where it was really clear what was going to happen, and for some reason the market just didn't believe it. Okay, like I was long the oil, right? I knew what was about to happen. I didn't know that Russia was going to invade and everything, but you know, that all kind of played out almost exactly the way that we kind of expected it to. And then I also said interest rates were going to rise, and techs were going to get hit, and they did. So definitely over the year. But if we go into, like, for instance, stagflation, like, that's going to be hard to make, because that's going to be an environment that's going to be difficult to play. And, you know, one of the difficulties that we've had is that even though we might have made the commodity play correct overall, they had like one really good push up, and then since then commodities have struggled, right? It's been hard trading. Yeah, well, I was saying reaction was right on the number, plus the 1 year expectations was the lower, which just didn't add up. When I look at the inflation expectations based on consumers, you know, that's a number that I anticipate to have a pretty wide range of error on it. So I didn't see anything in the numbers that came out that I think we should read too much into. You know what I mean? Because what you're doing is you're asking people what they expect something's going to be worth in a, or you'll have to pay for in a year or whatever. I don't think that that's something that's likely to be too accurate, right? Or another way of putting it, if you look at that data series, you can see that those expectations can fluctuate wildly. Too many nuances to make something out of it. Yeah, I think so. You gotta remember that in a normal environment, Paul, that nobody would even, like, my Forex Factory calendar doesn't even list the inflation, the different year of inflation expectations. It just wasn't something that people looked into a lot before. It's only because of the inflationary environment now. But I like what Uzi says here. Broadly speaking, it's funny to see people show how we live in strange times, but still predict the future with a normalcy bias. Everything is crazy, but it's all normal. Yeah, I like the thing that weirds me out the most in this economy right now is all of the people that are predicting that we'll be in recession in 2023. We'll fall into recession the second half of 2023, and I'm like, how? What makes you think that you have any ability to predict what's going to go on beyond just like the next day? Like I can come in and I can list like what the expectations are, right? But the market expectation is definitely that the federal base case is the Federal Reserve raises rates in September 50 basis points and then maybe a 25 basis point hike in November, although that might be changing, right? But for me to say that that prediction is extremely likely to be accurate would just be absolutely insane, right? The market that we are in right now is so bizarre. We really have no comparison. And as such, we must expect that our expectations are more likely than usual to be wrong. It's a mess everywhere. Well, it is a mess everywhere. It's just the problem is that the messes are inflationary, not deflationary like they were before, right? I'm a little concerned about the drought everywhere thing. That really doesn't, I really wonder about that one. It's just all of a sudden 1 year, everywhere drought. What? I thought, how is that possible? It can be drought everywhere. Where'd you get that one, Octavius? Over 40% of people with 8-year credit are behind in their car payments? What? Really? I don't believe that. Really? Oh, now Ethereum is an interesting one, right? Because I was really starting to become skeptical that the merge was never going to happen. My understanding is that if based on when they expect it to merge and everything, that it will be about a month. I'm not 100% sure what happens with Ethereum after that. I feel like that a lot of the drive for Ethereum was because you could mine it. And, you know, all these guys had these graphics cards to mine it. Does it work when it turns into proof of stake? We haven't seen it yet, so I think we just kind of have to. I think we just kind of have to watch and see what happens. All the platforms are being attacked for a reason. Yeah, the reason is that there was widespread and massive fraud that the financial system just completely ignored, hoping that everything would be fine. Now they're realizing that they're behind the curve and they're trying to make it up. That's why this stuff is happening, Anthony. Like, look, if they wanted to kick it down, they should have been doing stuff in like 2018 and 2019. That was the opportunity to kick it down, right? They let it grow and fester. The US regulators in particular said, well, we don't want to be blamed for Bitcoin failing, so we're just going to let it go on. And then they let people commit all of the fraud that all of the laws we have in this country around finance were designed to prevent. And now you're all like conspiracy theory about it when people start to actually like try and apply the law to it. Come on. Okay, so I watched last week's CPI stream on the release, and you said you saw the market trade that the CPI would be lower than before the number. How so? Well, because crypto was dying, and yeah, it was. It really was, Paul. I wouldn't say dying. I wouldn't say dying, but it wasn't doing super well. And then when 2020 came along, they took a really, really big hit, and it really looked like, okay, all of the reasons that people have been saying to buy Bitcoin, it's clearly not that. But then it took off anyways because there was so much money everywhere, right? Anyways, so Paul, I just kind of had the impression from looking at what all of the analysts were saying and kind of some of the tea leaves that we get, and it's kind of hard for me to like enumerate them because a lot of it is just kind of like flavor that you pick up from reading a lot of economic reports and stuff. But it looked to me like that the market was kind of bracing itself for like another really big bad report, because that's what's been happening lately. And so it made more sense to bet on the shorter side, and so that's kind of why I was going through. But you notice I wasn't like saying, oh, take a trade before it or anything like that, but just rather that because of the way that the market was positioned and what we actually see the fundamentals suggesting, you were probably better off looking for CPI to underperform. I need to eat. Like, I've been yapping here so much, and I've only eaten a third of my food. Well, I definitely see this thing going on in Ethereum where, at least in the short term, everybody wants to lock up their Ethereum for the quote unquote passive income. The problem is just like, okay, but how do you actually use that passive income, right? You have to wait to unlock it, and then you have to sell it. I think that the end results in Ethereum here, the likely end result is probably a lot more volatility in Ethereum, right? Because what happens when nobody wants it, right? So if the entire basis of your asset's value is based on there being low supply, what happens when the demand for it completely collapses, right? Because of that restricted supply, it's going to be much more responsive to changes in supply and demand. So you're going to end up with more volatility either way. But I'm a little skeptical about this whole like, oh, like we're going to go to proof of stake and then it's just going to go up forever. Nothing's that simple. And like one of the things here was that it was the miners were one of the big like supporters of the ecosystem, right? Like things were going down and things were getting rough. There was always the miners there, and mining ended up being one of the key inflection points where like when mining became unprofitable, things came back and things were able to adjust and everything. If you don't have that in there, and it's replaced by people staking, the problem is that the people staking can't really do anything, right? Because their power all comes from having their Ethereum staked, and so if they want to actually do anything, they have to unstake it, right? So I'm not really sure how it's gonna play out though. I'm really not sure. It's gonna be weird. It's going to be it might also be a good test case for Bitcoin. Like, what does Bitcoin do when they're all mined out, right? How does that change the ecosystem in Bitcoin? I'm not so sure that Bitcoin just being completely mined out will be a good thing. Okay, well, since that New York Fed number, the S&P 500 declined about 10 points and has now climbed back 5 points. So nothing too excessive. We'll see what the S&P 500 does when they open up, if they kind of continue the other assets in the risk off. Seeing corn is moving down. Maybe seeing a reversal in oil though, so. Risk off market sentiment, but treasuries didn't have no. I think that the treasuries did have a very strong reaction to the New York Fed. New York Fed manufacturing number is not typically like an A series release or anything, and there was a very significant amount of volatility around that event, and there was a pretty strong trend up going into the news, suggesting that perhaps traders knew what was coming and front run it. The S&P 500 did not react too strongly to it, but they did in the end up moving down 10 points. I don't know if that's significant or not. But the market overall does look like risk off at the moment. But we've seen very often when that happens, the S&P 500 rallies, right? So we just kind of got to sit and see what the S&P 500 does now. I think that a lot of the risk off is probably due to the bad Chinese data that we got overnight. Well, it is, yeah, it's sitting unchanged now, but I would count the whole move from like what in the treasuries from like 119.13. I would count this whole move all the way up to there was probably part of the New York Fed manufacturing news. So I'm sure glad that I said that, like, well, I missed a trade because they front run the news and didn't do anything, because it has kind of been sideways since then, hasn't it? Okay, so I'm seeing Trading Floor Audio tweet a heads up that Fed Hawk and voter Waller is due to speak at 10:50 a.m. Eastern time. So about oh, you got a ways for that. That's going to be like towards the end of our trading session, right? Seems like a fun time to trade oil. I mean, it kind of depends on what your idea of fun is, right? I don't put oil and fun in the same sentence. every time I think I got something going in oil, like, look, I lost like a ton trying to trade it on the futures, but I made a ton with it in options. So like it all worked out in the end, but whew, man, that was crazy. Oil, it would just eat you alive, man. Like, I think the issue with oil is that everybody comes in and tries to trade it with technicals, and there's just too fat. Like, when it moves, it just moves too much to try and do something like that. And then the other side, the other problem with this is that, you know, you as as a retail trader, like the amount of information that you can glean from public information that you know, is very little. Like you're gonna be behind the curve a lot, because these guys, it's like an international thing, and these guys in the Middle East and stuff, they can know all sorts of stuff that you don't, right? And they can trade on it. It's basically like everybody that you're trading against is an insider trader, you know? Like that's what's hard about oil. You can totally do it. You can totally become like the guy in the know in oil. I just think that it's harder to do than most other commodities. Do you think the 2-year can go higher? I'm a little surprised at how high the 2-year has gone. I think that the 10-year should be higher, but the 2-year, I'm like, what? Like the 2-year being at 3.2 and the 5-year being at 2.9 seems really bizarre to me. I think that there are a lot of, you know, supply and demand dynamics going on in the treasury, creating distortions in the yield curve rather than expectations about future rates being the dominant factor, you know? If the terminal rate is 3.2, but I'm not so sure that it is. Like, that's the thing, is it looks to me right now, if I had to predict the terminal rate, I would predict 3. I think 50 basis points in September, that would put us at 2.75. And then 25 basis points in November would put us at 3. And then I think they hold off on any other further increases. Now, what the hell is this? Bob Iacino, does the Fed have a credibility problem and do they care? In what universe can the Fed justify a pivot with year-over-year inflation at 8.5%? Half the dual mandate of price stability and maximum sustainable employment is in danger, not the other half currently is not. Unemployment is 3.5%. If it was the other way around, inflation at 3.5 and unemployment at 8.5%, Fed watchers would call for rate cuts in QE despite inflation being well above target. Would they not? This is the ultimate test of the Fed's independence and desire to adhere to its mandate. Well, no, I don't think that's who's talking about a pivot. The Federal Reserve certainly isn't the one talking about a pivot. Is that a Shure microphone? It is. It is a Shure 55. It's like a stage microphone. Not the best for streaming, if I'm honest with you, but it sure looks cool, doesn't it? Maybe at some point in the future I switch, but actually I don't think I will. I think I'll probably keep with this microphone until it doesn't work anymore. I do want to upgrade the interface at some point, but I think that's happening anytime soon. I have so many other things that we want to do. I am probably going to have to splurge here as soon for more hard drive space. So yeah, I think Elvis Presley used this one. So there was a little bit of a spike here in the treasuries, and that did make me think, okay, is there going to be another leg meta order up? But it was a little fishy, to be honest with you. And the thing is like the liquidity is really light and it's not actually moving too much. So that is not a situation that I think I want to trade. The way I said that was weird, but it's fine. It's fine. So let's see here. Oh, I do have a video coming out today. That's not quite out yet though, is it? I'll grab that when that's out. I think that one comes out at the bottom of the hour here in 10 minutes. And it's about the Federal Reserve and following the news on the Fed. So I think it'll be a really, really good beginner video. I don't think most of you guys here on the stream, you probably know these things, but it would be really good for people starting out. And I really liked the way the video came out. I wanted to do more. I wanted to do some funny things and make it, you know, a lot more entertaining. But when I got to editing, those parts didn't work and had to scrap them, and it was too late to try and redo it. So I gave up on that idea, but that one was good. I got some other, I think I want to do at least one more video on treasuries that has more to do with, you know, what are the actual individual drivers of order flow in the treasury market. But that one might not be for a month or two, because I think that I've got at least 2 other things coming in between them that will be really really cool developments in the industry. So but man, if the next month ends up being bad, I'm maybe more concerned about like another risk off downturn in the stock market. Maybe I'm more concerned about that than I should be. But hey, S&P 500 looks like they're okay with what's happening right now, right? I don't know. I think we should switch our music. Well, outside of the New York Fed manufacturing number, the order flow has been largely what I was kind of predicting from before, and frankly concerned about, right? Not seeing too much happening in the spreads, maybe a little bit of steepening on the longer end of the curve, but nothing too big. I was looking here in the New York the manufacturing survey. There was a decline across all indicators, but especially by a sharp drop in the forward-looking new orders, which tanked to negative 29.6 from up 6.2 before. Manufacturing activity declined significantly in New York State. And Zero Hedge saying, mocking the relentless data fudging by the politicized BLS, the report showed that the index of employees moved down 11 points to 7.4, pointing to a small increase in employment, and the average work week index fell to negative 13.1, indicating a decline in hours worked. The prices paid index fell 9 points to 55.5, its lowest level in over a year, indicating a deceleration in input price increases. The prices received index was little changed at 32.7. Looking ahead, the index for future business conditions came in at 2.1, suggesting that firms were not optimistic about the 6-month outlook. The indexes for future new orders and shipments were positive, but remained at low levels. On the other side, employment is expected to pick up, which makes zero sense considering expectations of plunging inflation, and delivery times are expected to decline over the next 6 months. Only modest increases in capital spending and technology spending are planned for the months ahead, which of course means much more stock buybacks. You know what I'm saying? Where it's like this risk off across the board thing might not necessarily mean that you sell the S&P 500, right? I mean, it's something that I got to be looking out for, because this is definitely a thing where, you know, they'll buy the treasuries and then turn around and sell the indexes when the indexes move up. But I'm actually kind of at the moment leaning more towards that the S&P 500 buys, because they think that means interest rates will be easier. Although I really don't expect interest rates to come down. I think that we'll probably get to 3% and stay there for a while. Zero Hedge changed the name of their front story to be Recession Back On. So if we do have another downturn, what do you think? How do you think it's going to impact people? Now, I was just thinking this morning, because there's another thread on Reddit about like, oh, okay, who are some people on YouTube that do live trading that you should follow? Of course, I never get mentioned. That's fine. Nobody wants to trade treasuries. It's okay. We don't want competition anyways. But some of the people that got mentioned, there was a lot of conversation, like back and forth about certain creators and stuff. I was a little bit surprised. I'm wondering if maybe some of these guys aren't doing as well as they have recently. I don't know. But usually when I see that kind of reaction, I can remember really, really early on, like when I first started streaming, I was doing really amazing for like the first 3 months of like actual recording this. And then, or no, was it live streaming? I think it was when we were live streaming. But and then that summer came and it was just dismal. It was like every freaking day. Every freaking day it was bad. It was a loser. I was trading on sim, but I would lose like literally every day. And couldn't figure out what was going on. It was just the craziest, worst string rut I've ever had. Hopefully that I ever have. It was bad. And I remember that there was one or two guys that started to get frustrated with me. Like, of course, I don't want people to follow me. I'm not responsible for your trades, right? But, you know, if I'm doing poorly, you got to anticipate that there's probably other people, even if they're not trying to shadow my trades, but, you know, there's going to be other people in the market frustrated. And I read that, and that's kind of what I thought was, well, okay, if people are starting to turn on some of the more popular YouTube live streamers, that must mean that a lot of people are struggling now, right? What symbols are you using for your spreads? Well, so I have a chart up for all of the three main treasuries, and I primarily have that because I want to watch the cumulative delta between them, right? And so then I just add a spread to each chart to kind of help me watch the different parts of the curve. So on my ZB chart, I have the knob spread, which is 5 ZN and 2 ZB, right? My version of the spread indicator is a little bit different. You can see like down here at the bottom, I have to put a -2 in there now, and that's because I've changed it so that there's multiple, you can have multiple legs. I need to work on that a little bit today. Then on this one, I got 3 ZT and 1 ZN. And then on the 5-year, I have the 5 and 30-year spread. So I've got 4 ZF and 2 ZB. And that's what I'm using for spreads. And then over here, I also have one for the NASDAQ, right? And that's ES versus NASDAQ. Well, Treasury's threatening the high. Oh, well, the 10-year did get to a new high. The 5-year hasn't quite yet, though. But it looks like there was at least $10 in it for us. We taking it. I still haven't quite wrapped my head around how you use the spreads. Okay, well, so I think that let's try a different way of explaining it, okay? I use spreads primarily to avoid getting stuck in a trap with the order flow. Because no, I use it more as of a big picture thing. So like the thing that I found tripped me up a lot early on was like right now we're trending up, okay? So if we were seeing flattening, unfortunately we're not seeing flattening. We're not really seeing anything in the spread, so this doesn't make a very good example. So let's just pretend that we were seeing something or we were seeing flattening, okay? Then what you're gonna see, flattener, just I always remember, or the way that I kind of, the heuristic that I use to make it easier for me to make decisions on the fly is tilting up is steepening and tilting down is flattening. That's how I do it, okay? Tilted up, steep, tilted down, flat, okay? So that would mean if we were flattening, you would see selling in the 5-year and buying in the 30-year, okay? So if I came in here and at the highs of the day, I saw an absolutely massive, just ginormous order iceberg offer in the 5-year that they just can't seem to get through, right? That might make you say, well, maybe that's the high, maybe they're going to turn there, that sort of a thing, right? But if I know that we're flattening and we're flattening really hard, then what are they going to do? They're going to be selling here and they're going to be buying here. So what that means is that the order flow in the 5-year side of is not likely to be very indicative of where we're going, right? And so that's kind of a big part of how I use it, is that I want to see, you know, which way that spread is going so that I know which side of the spreads to kind of be like, okay. Another thing is that more recently I have been using it to decide which side of it I'm going to go. Like when we've been steepening, I'm more interested in buying the 2-year or selling the 2-year over here. This 2-year will move more for me in the micros, so I might take it there. Whereas if I think that the long end is going to move more, I do it in the 10. I don't do it in the 30 because I can do it in the 10 and get better liquidity. So that's kind of what I'm doing. But at the same time, I'm also kind of looking for like, well, if we're having a good trend up, I am going to see the cumulative delta on all 3 instruments tilting to the upside, which is what we're seeing right now, by the way. It looks like we are in the end getting another leg up of the meta order, and it came in at about the time that we should expect. That's probably a little bit too late for me to jump on, but looks like we are getting that. So, you know, I want to see them all going. And if I'm getting a strong move, I'm working on this, but I do kind of want to have an inkling about which way it's going to go, right? Like right now, the market seems to be suggesting risk off. So I think that a bull flattener makes sense, right? That the treasuries move up and they flatten. Right? Whereas if the economy starts doing well and the market starts to price in additional rate increases, I expect to see like more of a steepener. So that's kind of how I use it. I really feel like that when you're reading order flow, if you don't have all 3 of them up and you understand how the spreads work, you're gonna get a lot of false trades. Like you're gonna get faked out a lot because you're gonna see all of these things that don't match up with the direction, and you're going to think that you should go along with the order flow instead of the direction. And it can happen the other way around too, of course. So, but I'm also trying to discover some statistical irregularities in it. I have found some stuff that suggests certain trades that you can take. Not trades. So the issue is it's kind of more of a portfolio strategy where barbell strategies and there's all these different ones that they do. So I'm kind of sit here and I'm like, well, if I was managing $1 million, I could probably use that for the basis of a fund, right? But for little old me just trying to do individual trades, that information didn't seem to be too useful. But it kind of suggested to me that there might be similar statistical aberrations in intraday data. Like, I think that it might be the case that if you see the yield curve steepen or flatten X amount, that you're extremely, extremely likely to see a short-term reversal. It seems like that there is like a significant amount of mean reversion in spreads and that they can only go so far at once. So you might be able to use that to kind of find pivots and or take ticks out at times. I've always had ZT, ZF, ZN, ZB up on the screen just looking for an easy way to visualize the curve trades. Yeah. Well, what I did was, because on my indicator, which you have, I'm going to update it. Hopefully this next week. I'm almost done with at least what I want to do on the spreads and adding the additional indicators. When you put the chart on, again, if I come over here, you can see this chart is moving up. This chart is moving down. So I'm going to say this isn't significant enough over here. But it does look like in the 2s and 10s that we are maybe getting some flattening, right? So what I want is I want my DOM to be the same thing. I want it to be when it goes down, it's flattening, and when it's tilting up, it's steepening. And that's why I have the 5-year on the right side instead of the left side, right? So I do it. ZB, ZN, ZF. I don't remember who showed me that, but I'm glad that somebody showed me that because I think it's a great trick. And then you notice that when I do the yield curve on the bottom down here, it's the opposite, right? It's the opposite. But because it's the opposite, it still does the same thing, right? Up is steepening and down is, but the 2 and the 5 are on the left, down on the bottom. And that's why I have them split. So it makes it easier for me to quickly say it's steepening or flattening. Oh, okay. Yeah, this chart over here, I'll make it big. So on the 10-year, because I trade that more actively, I have price action swing on there, and it is the number above and below shows me how many ticks it was. So that's really just more me trying to sort out what the volatility is. I wouldn't say that I use that too much these days. But I mean, you look at it. Hey, look, this move was 23. This move was 17. This move was 22. It kind of gives you an idea of like how far is like a crazy move. Was that move that we just had up to the highs, breach of new highs, was that insane? It was somewhat tame compared to other moves that we've had recently. But I don't make decisions off of it or anything. The thing though is that I think I would point out with the indicators that I use, and I think I'm going to make some TikToks about that this week because it seems like people are interested in hearing about tools again. When you look at what I'm doing on my charts, there are 3 things that I try and show in my charts. One is relative value. So how well is one instrument doing compared to another instrument? Number two is volatility, something that gives me an idea of how much volatility is in the market that day. And three is degree of autocorrelation. So especially for the indexes, I want to know if they're just trending. And in this particular market, I'm not finding that autocorrelation to be too useful. But in the post-COVID market, it was really, really useful. You could get really, really good trades out of that one. So that's kind of what I'm doing with my charts. I don't never use charts for a signal though, right? My approach is I have a piece of information that predicts future orders. So I know that I want to buy or sell it at any given time. And from there, if I know, basically just say to yourself, I know that it's going to go up or I know that it's going to go down. Okay. So if I know that, how do I take the trade? How do I get the most optimal trade? Right? Well, you could just buy or sell it at any one given point, right? But, there's kind of this whole thing where it's like, well, okay, if we just had a breach of new highs and a really strong uptrend, I don't necessarily want to just buy right into that, especially if it was a really fast one, because what? There's going to be the liquidity hole. We're going to pull back, right? So I can kind of look at the past volatility and I can watch the volume and the volume profile for the liquidity holes to potentially try and get the lower end of that range if I think that it's going to continue to go higher, right? And that will give me a more optimal entry. And then on the split side, it also can help me know when to get out, right? You went short the S&P? Does look like it's turning down. Oh, I don't believe you. You say you got 67. I don't know if I believe you, dude. That was a really lucky pick if you really got 67. Does look like a good spot to go short if we wanted to. If we wanted to go short in the S&P. And it seems like it's turning down really well too. And the treasuries kind of are suggesting that they're going to keep moving. I didn't take a trade primarily this morning because I was eating food and I was not prepared. I think I could have come in and gone short yields. I'm not, even if I was ready though, I'm not sure that I would have done it. I think that what we got here this morning is kind of seems like sentiment and I can see where the money is going. And I think that could be enough to run with, but I don't know, man. Like if I get a trade like that and I've made like $20, I'm usually thinking, oh, that was pretty good, right? This thing is starting to look like it's going to go a lot further than that, and that makes me a little skeptical because now I'm sitting here thinking, am I like getting ahead of myself? Is this like where I would try and go short micro yields and just get absolutely slaughtered? That New York Fed manufacturing number, though, that's probably all you need to be able to say, like, yeah, probably you sell yields today. Yeah, 120 evens on deck. It's true. I think, well, so we could take it over here on a sim trade. I'm just not so sure that I'm on the ball enough to really take a live trade, but we can try and see if it we can try providing liquidity here and seeing if it help works for us. It kind of looks to me like there are still some low liquidity and that it's moving on not a lot of volume. So the Japanese yen looks tilted to the upside though. So Surprisingly enough, you didn't really see a super strong recovery in oil. Or sorry, gold is still hurting. They did pull back a little bit, but overall I'd say gold is still hurting. Yeah, so far it's looking like I think that they could still touch 120, but it's pulling back a little bit more than I anticipated. I'm seeing a little bit of selling on the long end of the curve. I'm wondering if maybe a steepener is coming in. They come back like what, 4 ticks, and now they're just kind of chilling at 29. Problem is 2.78 on the micro yield's a good place to go short there. I mean, it's only like 5 ticks back, and this pulled back 5 ticks. This is not very good. Looks like the spoos are going higher. It's interesting, this push higher in the treasuries was very much correlated with when there was some selling in ES, and now it's going the other way. Yeah, nobody's hitting that order at 28.5. Now there's 1400 on it. It looks to me like there's a real liquidity hole at 29. So if you wanted to sell, why would you sell it there? You probably could sell it at 29. I think I might be able to get away with one right here. It doesn't look too great here at 29. Like, that looks like a liquidity hole, and trying to like buy at the liquidity hole point and take one off, like 1 tick above or below, is usually doesn't work. But we've had more volatility than that. The liquidity looks pretty low. I think that the volume, okay, so that was fine. I think that there should be enough volume to pull us out of that hole, and it shouldn't matter, but especially for one tick. Okay, cool. I think we're okay. Okay, let's see if we can do it again. Well, if we had taken 2.78, I think we'd probably be feeling pretty good about ourselves right now, wouldn't we? I feel good about what? You think the S&P 500 is going to go to 5K? Oh, you've been writing this trend in the ZB. I see now. You're saying, oh yeah, you took it and you're feeling good. I gotcha. Yeah, that's a lot to risk on a Monday, dude. What percent? I probably shouldn't ask this question. I was gonna ask what percent of your portfolio is that, but I don't know if you should really answer that question. You know, is that like a 20% winner or something? This. $17 contract seems like a lot. I'm kind of wondering what it is that would make you feel so confident to be willing to put that much size on. Spoos seem to be liking what's going on so far. Maybe it might give us 2.78 again. Oh, that's kind of interesting. Oh wait, what is this? Scott Adams retweeting someone, if you homeschool your kids, they won't fit in with society. And then it's got the guy saying correct. Oh, I like this one. I like this one. Yes. Yes. Not fitting in with society is not necessarily a bad thing, folks. You need to teach them enough to be able to interact with the world, but you don't necessarily want them to be of the world, right? Or that's what I always say in Utah. So you want to be in the world, not of the world. And nobody's ever quite sure what that's actually supposed to actually mean. Seems to make sense, right? You got tired playing with it. Well, yeah. I think that, yeah, well, yeah, I feel the same way, Lafta. No, I like, I have to tell you, I mean, I'm telling you, man. the more money you put on, the more stressful it is. And there is gets to a point with me where like I can get super stressed out about it, and then I do dismal. And I've been a lot happier since I've been doing this with micros, but I find the overhead costs very, very frustrating. I've been doing quite well, but the overhead costs take most of the profits, so I don't like that. How do you determine what the sentiment is with spreads, i.e. knob trading higher, tot trading lower? I can't wrap my head around it. Well, so one is, I'm just going to be looking at what the last move that it did was. I'm not too sure that I really can see quote unquote sentiment in spreads. Okay. But there are some situations where I do think that I have a pretty good idea of which way this spread's going to go. Okay, so look, they did finally take that 28, and it was only 16 and a half contracts to do so. That's a little okay. Anyways, there are some situations where, you know, like on what was it, Thursday or whatever, when we got those really bad numbers, and I said, oh yeah, like interest rates are gonna plunge here, and you're probably gonna see steepening because it's been flattening for so long that interest rates coming back down, you should see steepening. And of course you did, but it was very short-lived because then the Federal Reserve came up and shoved the markets back down. But, you know, every once in a while I do have something where it's like I expect that the curve should steepen or flatten or whatever, and then if I see it start to happen, then that just kind of reinforces my trade. But I have to say, spreads are really hard. Like that trade that I caught on the spread earlier in the week, you know, that was probably my biggest success with spreads, and it wasn't that, it was pretty modest. So, well, the markets came back down a little bit harder here. Oh, what's with this iceberg at 28? I'm wondering if I've fallen victim to a spoof here, guys. And looking at the volume, there was pretty strong amount of selling, especially in the 5-year. Do you see flattening now across the board? I don't think that that's very in line with a continued uptrend. So, you know, I was taking this one mostly because we were so close to 120 even that I thought we were going to get it. So I think that I can keep this spread trade on. But we were also kind of stocking the 10-year over here, and we were like, oh, like 08, maybe 08 half. And we wouldn't have gotten filled at 2.770, right? So it's probably better for me to just remain hands off over here in the micro yields. It's not moving enough to really, for me to really get a good profit over here on this side. In the 10-year, sure, we could work it out, but it's going the wrong way. It's going the wrong way. I think that I probably need to bail. Yeah, because I've got a lot of contracts on. It's a lot for Sim, and for Monday I'm going to click flat. I'm kind of keep an eye on it here though. I wonder, so when it was, remember I was saying that like when the S&P 500 went down, it looked like the treasuries were going up, and then, but then we had a more dramatic upturn in the equities, and that time the treasuries really sold off of it. So I'm wondering if the treasuries are mostly being driven by equity hedging at the moment. The knob and the tut. Sorry, which one is? I don't know the names of them all, dude. The 2 versus 10. Okay, so yeah, this is the one that where it gets weird, Paul, is that the ratio for the knob versus a 10-year and the tut, which is the 10-year versus the 2, is kind of weird. So the tut is supposed to be 2 10-years, sorry, 2 2-years and 1 10-year. And so they do end up, you'll see it like if we're getting flattening, like probably what you see right now is, well, actually you might see them both going down at the moment right now. Actually, it's kind of weird. But my spread, my 2 10-year spread is 3 to 1 instead. And so that one matches all of the other treasuries more. So right now, if it's a little unclear to me if we're going to be steepening or flattening for the next leg, but they would all be going the same direction. Right? I don't know though. I really wish that there was more volume in these micros so that charts looked better. Because if I try and pull up a chart of just the yields, it looks like it's really hard to read because there's so much missing. There's many bars where like nothing happens. But looking at a spread between these micros is like makes so much more sense, right? Like it really kind of made, I always kind of thought, okay, like is the amount, like what's the perfect ratio to use for like the knob, and like, does that changing really matter that much? Apparently it does. Apparently it does, because it's way easier to do it in the micro. Okay, so we got some pushback there. What the fuck? So we saw about 4,000 contracts sell in the 5-year, and we just saw about 4,000 contracts buy back up in the 5-year. So it just completely reversed. I think that if, man, I'm having a hard time here because I don't think that I'm going to do anything, but it's pretty hard for me to say what I'm about to say and not take it. If you were looking for your reason to go short yields here, that was probably the best reason that you're going to get. You know, because there was some like really aggressive pushback buying. But I don't think I'm going to touch it. I think one thing is that normally a move like that would like really have me wigging out. Like that's really, really strong order flow. And like I'm saying to you guys, oh, that seems like really strong order flow. But I'm kind of realizing, well, liquidity is still a little iffy. So that move might not have been as significant as it seemed. Something definitely changed there though. Like the treasury is moving. Sorry, the equities are flipping back around and are selling again. Oh yeah, the housing, was that the housing market number? Oh, you're right. Did I not hear the hell? Oh no, I am hearing them. US NAHB housing market index was 49 versus an expected 55. So that number doesn't necessarily give me a clear direction, though. I mean, weaker than normal would probably suggest the rates could fall. But knowing what just happened there, that kind of makes me say I don't want to take a trade in this location, right? That kind of makes me think that we're just going to have a hole here. Have you heard about how many techies that work from home are now? I did read stories about that. And people in Mexico were complaining about gentrification and stuff. Yeah. I don't know what to think of that. New one? No, probably not. So when I think about a house, certainly I would love to have like a huge house. Okay. Like if I had a huge house and I could have like one room just for streaming and or trade. Like I would like to have one room that's just for trading and one room that's just for video and music production. And one room that is just like an office / conference room, right? Do I really need 3 rooms? Like, because those are all 3 things I do in this one room right now. And yeah, would be really nice to have, but do I really need it? No. And like to have a house like that, I would probably have to be in a multi-million-dollar house. And I kind of have a hard time justifying an expense like that, you know? Not from a perspective of like, I can't afford it. I mean, obviously I can't afford it, but if I could afford it, nah, I think it would be more of an issue of, yeah, but I could stick that $1 million in the markets, right? You're right. Well, she has a room. She has and she never uses it, but she has a craft room downstairs that she doesn't use very often right now. But the one thing that would be really nice would be a bigger pantry. So we have a pantry, but it's not like a huge walk-in one or anything like that. It would also be nice to be able to like have a room just for my weightlifting that's indoors and is cool, because the temperatures have kind of hurt my workouts lately. Yeah. But I think that if I was going to go that far, it would have to be like a $5 million house, and I'd want to go and build it like somewhere way out there where I can have my alpaca farm and stuff, you know? Like I'm talking like the big, that's what it would take to have to get me to move though. Like that's the thing. That's what it would take to get me, because right now, you know, like we live close to my parents, and so they can come over and help with the baby, and it's a unique area that is very, very safe and so forth, but not like filthy rich, and I really like it. So it'd take a lot to get me to move, buy a new house. Would take a lot. And Naber about the futures, not yields. Yeah, you're right, actually. So actually, I was trying to figure it out yesterday, and I think I did sort it out on my own in the end, but I changed my spread indicator, and it was 3 ZT and 1 ZN, right? Was the best ratio to keep the 2 and 10 in line with the knob and the others. The American dream, that 5 million home. TUT 4v1 is the price ratio? You think I should have 4v1? Well, no, right now it says that TUT is 2-to-1. 2-year note versus 10-year T-note. Okay, I'll change it to 4-to-1. I think he's explained this to us multiple times, and I've never understood what he was saying about why why I should put 4 instead of 1 on there. But I'm gonna put 4-to-1 on there. see my ZFZB is 4-1. My FOB, I got 5 is 4-1. I don't think he was saying the treasury spreads are basically useless and that the futures yield spreads are better. It really has more to do with what you're trying to accomplish, right? Maybe it's not even so much what you're trying to accomplish, but like I guess the thing that you have to realize once you really get deep into it, the thing that you realize is that the treasury futures are in fact a derivative, right? So using them as a signal is aiming in the dark. I agree with that. Yeah. I suspect that you might be able to find a technical trade off of them that might have, a really fat tail. So something that you'll win on taking somewhere where you'll get a mean reversion trade where you'll win most of the time. And the one time that you don't win is when we're going into a recession, right? I suspect that might exist, but trying to use, see some change in the spreads over here, and that means that you want to enter into a trade over here in the outrights? No, I don't think so. So what could they be used for? Well, so again, you really want to know what direction the spreads are going because you don't want to misinterpret the order flow, right? Once you understand which direction the spread is going, you will realize that, oh, I should see more buying over on this instrument and more selling over on this instrument. So if overall I think that we're trending up, I kind of have to ignore this instrument over here that's selling because it's not going to be in line with the other ones, right? I'm kind of tempted to go long, not long, go short to treasuries. We do have Waller in 30 minutes. We have Fed's Waller in 30 minutes. I don't know if a trade here makes sense. Two contracts in ZT is 2x notional, thus 2x price. How is that exactly? Here, I'll show you. I went back to Rhythmic, I did. So like I kind of I shouldn't have done this, but I was kind of running down my NinjaTrader account anyways, and then there was that one day where like it was broken. What was the problem? I don't remember what the problem was, but basically NinjaTrader, for no fault of my own, was broken and I could not trade. And they had to fix something and they were really slow to respond. So I'm like, well, I don't know if I can justify using you anymore because your service was just not very good. And then I took a bet over there that I shouldn't. Like once I knew that I wanted to switch, I took a bet over there that I shouldn't have to kind of, I took like $100 loss or something like that. And then that was like, okay, well, this account is pretty much gone now. So I went and I took the money that I had and went and funded a new account at EdgeClear. Been doing really well with that account since I switched, by the way. And yeah. So I've been with EdgeClear. I've kind of gone back and forth. Because they have like their EdgeClear X platform, and I'm like, oh, that kind of looks interesting. I have to admit though, it's not. I don't think that there's another charting platform out there that's as good as NinjaTrader. It's possible to make a charting platform that's better than NinjaTrader, but I don't think it really actually exists. It's just like the whole licensing situation over there in NinjaTrader kind of sucks, right? Because I can use NinjaTrader with my Rhythmic account. It's just I can't use like my licensed version of NinjaTrader with Rhythmic, which is really dumb. So yeah, but we'll see. Some interesting things are coming down the line that we'll be toying with. But yeah, I can't get MBO data, but neither NinjaTrader nor Jigsaw can utilize it yet, right? So the better platform, it's called Excel. Well, so you know, I haven't seen you as much, Akshay, but did I tell you the whole thing about Refinitiv? So like I thought, okay, I need to get the actual treasury. I need to get like actual benchmark data from like the exchanges that are trading actual bonds. So like TradeWeb or what's the other one? BrokerTech, right? And somebody gave me a tip and I found a way to get a trial for Refinitiv Icon. So I get Refinitiv Icon on, oh, your dog died. Oh, okay. I'm pretty sure that you had me on 3-1 before. The 3-1 chart looks better. Now I'm on 4-1. It looks like nothing's moving. Okay. And in fact, over here, like here, I'll show you. So here's this one. Here's this chart. Here's my 2 and 10 year spread down at the bottom. And it's 3-1. Spread candles. 3 ZT, 1 ZN. And if I do 4 ZT, yeah, that's not too much different actually. Maybe 4 is correct. But I think I had 3 before. It's a little bit more extreme, you can see up there at the top. 3v1 is Tux and contract ZT versus TN. That would be 6v1. But why I still don't understand why they listed as TUT is 2-1. Shouldn't it be just 2-1? If it's really 4 contracts, then why don't they? But you're saying it's notional. I think that you need to send me an email with like I think I need to get into the math of how they determine what the spreads are. This must be what I need to do, huh? And then I could make my own more informed decision on what ratio I want to use. Well, I'll turn it to 4-1 because you're telling me 4-1, and I'll change this. This one is 4-1. And yes, sorry about your dog. Okay, pull up the Treasury Analytics tool. Okay, let's do it. Oh, well, so first though, let me go back to the thing that I was saying. So I got Refinitiv Icon, and you know, I can pull up like their benchmark yields on there. And basically what I discovered was number one, there is a basis difference between the micro treasury yields and the cash yields, which I didn't expect, but I should have. It would have made sense. There's a basis difference in all futures, and you can trade the basis. Although I don't know how you would trade the basis in this case. But it was a lot more than I thought it was going to be, because it was like 1 to 5 basis points, right? And number two, though, was that the spread, excuse me, the spread over there is just as much, if not more, than in the micro yields. So that data didn't actually help me to try and do some sort of a market making strategy over here. So I kind of gave up on that idea. Treasury analytics, right? Okay, now what? So I think I go to like the 10-year or maybe an ultra 10-year. Right? Oh, enter commodity spread. Scroll down to ICS spread. Okay. Oh, okay. So here's TUT, front leg, 2-year, back leg, 10-year. ICS components, price ratio, leg ratio, front quantity 2, back quantity 1. Oh, index value 299, 219. Oh. Yeah, the settled value. Okay, so you're saying if I came back over to here and I said that this is actually 2-to-1 instead of 4-to-1, then the value that I get is 89.63, which is so obviously wrong. So that does suggest that it's 4-to-1. See the settled value for individual. Price or yield? Price, I guess. 2 and 10. Oh, what am I getting for? Hold on. Okay, no, that's correct. Okay, 104. Okay, so if we came in here and we said, um, 19.875 divided by 32 equals 0.621, blah, 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 plus 104 equals, okay, times 4 equals this number. We'll copy that. And then we will take the 10-year. Oh, no, it'll be, what is the 10-year? 8.5 divided by 32 plus 119. Okay, so then the 418 point, oops, 418 point, 484375 minus 119.265 equals 229.218. Yeah. That is exactly correct. Okay. But this, why does this say front quantity is 2 and back quantity is 1? I still don't understand. How do I know that for that one I have to times this by 2 and I get 4-to-1, but on this knob I just use the numbers that they've got? But on the knob here I just do 5-to-2. number of contracts, you have to adjust the notional. What does that mean? ZT futures. Is 2x notional? Okay. Specs. Oh, because the contract unit is face value at maturity of 200,000. You wouldn't know that anywhere else other than from looking at the contract unit, right? Others are 100K ZT and Z3N. Wait, what is Z3N? The analytics tool mentions it as well. Let's see here, where? I don't know what this price ratio is about. Oh, Z3N is 3-year treasury. Gotcha. Where does it mention the notional on here? Sorry, going back here to the Treasury Analytics tool. It doesn't say anything about the notional on this screen, does it? Am I missing it? Price ratio, it says 4. Okay, so if we do the knob, 5 divided by 2 is 2.5. AC. Oh. So what is the leg ratio about? Okay, well, we use 4 to 1. The other thing is that I got the book, right? I got the book. I got Steegum and Robinson money market and bond calculations. I haven't really started reading it. I went through the table of contents, and I was kind of like, oh, there's a lot of interesting stuff in here, but I don't know if any of this is actually relevant to any of the things that I actually trade. But it would probably be more like once I go through all of this, then maybe I would know exactly what it was I need to do. Oh, you're right. The leg and the ratio, the price ratio and the leg ratio are the same for all of them, except for the ones that involve the 3-year and the 2-year. You're right. Gotcha. I never would have figured that out on my own. I would always be like, something's not right. Oh, so stuff like that makes me always wonder, okay, so what are other things that I don't know, right? Yes, so the knob is correct at 5 to 2, but for the tut, you want to do 4 to 1. But the other thing, though, is that if you were to sit down and you were doing some sort of an analysis that is like, okay, I have discovered that when the yield curve becomes inverted by X amount, that it's a big problem for banks once it gets past this certain threshold, because that certain threshold, they're like losing money on it, or there's some fundamental reason why that particular price becomes important, right? Then I would be looking at the on the run micro treasury yields and determining the basis difference between those to say that we're at that point or not. You get what I mean? Their cost increases. Now the whole thing just kind of makes me is really interesting to me. Like, I don't think I've ever seen the yield curve more out of whack. Like, especially the 10-year. The 10-year, it just seems so silly to me. You know? Like having the 5-year at 2.9 and the 10-year at 2.7 and then the 30-year at 3 is like, what? What is wrong with this part of the curve? Apparently there's always a hump there though, right? It just seems really, really excessive right now, right? Cause like my gut, not my gut. I don't know what to say. Like the naive strategy here is, right? Sell the 10-year and buy the 2-year, right? For a steepener. There's always been a hump between the 7 and 10-year points. Yeah. The naive trade would be a steepener between the 2 and 10, right? And I think at certain points it makes sense. At certain points it makes sense if the Federal Reserve does lower interest rates, then you will see the yield curve like steepen all the way back out, right? But you know that like that the naive trade is probably not the best trade to take right now. You know? So like what's the best tactical decision to make if you were forced to take a spread trade that involved 2 legs right now? Where would you do it? You know? So there's something out of whack, but what's the best way to take advantage of it? I'm not so sure. I'm not so sure. Oh, that's not the one that I want. The thing is, if you actually see the treasury holdings for Asian central banks, they have almost always held the 2-year treasury. Really? Like even the Japanese are only buying 2 years? Who's buying all the 30 years then? See, look at the futures yield curve right now. Like what? What? It's very inverted. The demand would, of course, they roll into 7-year treasury after maturity. Now they're offloading their holding for a better part of this year, and demand would, of course, taper for the 2-year. Meaning 2-year down and 2-year yields up. So not as much buying demand in the 2-year. Okay, so you think that the 2-year is that basically you're saying 2-year yields are higher than they would normally be because of this roll from Asian central banks. That it seems like a reasonable explanation. I think I would need to go and find all of the data for doing that, but I think I know where to look because you can look at like the New York Fed reports and stuff, right? That is pulling the complete front end with it. So I believe you. I'm a little suspicious as to why I haven't heard that anywhere else yet. Because ED and Z3N would provide arbitrage otherwise. Yeah, when would that settle down? It would have to be... We would have to look at their holdings to see when they end. Because they're not buying as many. Well, the Chinese in particular are not buying as many 2 years, right? When China, India, and Japan have their house back in order, maybe? But the Japanese are still buying 2 years, right? So... Okay, but so you're saying if economic growth in China picks back up, then the 2-year yields may actually kind of back off a little bit, which is kind of funny to think about, right? So that could lead to a very perplexing move. Like you could see something where the yields move up overall, but that would you would finally get the bear steepener, right? Where the yields move up overall, but the long end moves more. They usually manage their forex pegs as well, right? So what we're saying, hold on, where's my to-do list? Where did Akshay learn all of this? Because he's a real professional. That's what that's about. There really is a lot of stuff, especially in the interest rate markets, I think, that I don't think you would ever figure out unless you worked on a desk at a bank. So I think what we're really saying is investigate duration of foreign holdings. And that would conversely also make me wonder if there are certain countries that are more likely to hold 30 years, for instance. Mostly books and hearsay, actually. Well, where do you find the hearsay? See, this is the issue in the treasury market, is that nobody on the internet freaking talks about it except for us. Like, oh, by the way, I should link our video here today. Formula One. It's been YouTube and the algorithms have picked up on that. I'm trying to do learn more about Formula One, and the last race for Formula E, there was this really weird crash where it was just like all of the cars decided to veer off the road and crash into each other, and they were like stacked up. It was so comical. I keep seeing videos about it. It's funny. Okay, so I made a video about how to trade Federal Reserve policy. Look at the thumbnail. Do you like the thumbnail? It's got a picture of Jerome Powell with deal with it glasses. Huh? Come on. That's got to be getting here. Okay. I'll put the link in here. Make sure you guys go watch that video, watch the whole thing, give it a like, put a comment on it. I want to know like what your favorite FOMC day ever was. I'd love to hear you guys' stories about that. when you've had the opportunity to work for like a 300-year-old bank, you get a lot of hearsay. I gotcha. I really want to know where people come up with that stuff. So one of the things that I say in that video is that like when it comes to trading the Federal Reserve, at least for public resources, there isn't any better resources in this channel. And I really do believe that. That might be like delusional on my part, but I really do believe that. And it's not because we're just that amazing, although I think that we have done a really good job and we've worked really hard, but a lot of it is just that the public doesn't really pay attention to treasuries. I think in part because, you know, the only way to really get involved with it is in the futures, and most retail traders don't have access to futures. I feel like that now that we have these micro yield futures, I really think that we should have more I really think that we should have more retail participation in yield markets. Yeah, so this is actually a companion. So Stigum, I think it's a lady, right? She wrote a book called Money Market. And this is like a companion book to it that is just about doing the math. So there's another book that teaches even more about the overall market. And so here's the thing, guys. Oh, I shouldn't be saying, you know, because now you're all going to go out and try and get this book. I got this one for like $5. I found it on eBay as an old book, and I got it for $5. So I haven't really had the time to go through it though. I'm still been going through. I've been getting a little bit better this past week at studying for the Series 65 exam, and I have this other book that a guy locally wrote that has to do with data engineering, which is relevant to what I do, and so I want to read that book. So I'm kind of finishing those, and then probably I get into Stigum's book. I don't know if that's one where I'll read like everything in there though, because it's going to be talking about all sorts of derivatives and stuff that I'm probably never going to be able to trade, right? So I have a video about here's how you add a button onto the chart to do something. And this guy is like, oh, that's way too hard. I was like, well, but it's real programming. That's how it really works on the GUI side. I don't know. You have some strange expectations. It's okay. It's okay, bro. I understand. You want to make it easier. But from a programming perspective, it's actually not that hard. So I will look to see, but I'm wondering because basically do you remember like 2 weeks here we were talking with Akshay and we are talking about this stuff and we're like, okay, so what should we do? Okay, so what we need to do is we need to find data and see what we can get from that data. So basically I got that data and the conclusion was that it wasn't actually that useful. Kind of sucks, right? So now it's kind of like, okay, so what should our next project be? Is there more that we can learn about yield curve trades and possible opportunities we might have? I really would like to find, if at all possible, any kind of edges that we might be able to glean over in these micro treasury yield futures, because I think that there would be some real benefits to the markets from more people being involved in these things. So I think this is a big opportunity for us. I'm the only one talking about it, and there's a real opportunity there, right? So for multiple reasons, there's reasons for us to position ourselves there. So any kind of research I can do right now that might give me an idea of what's going on over there, you know, I want to get involved in, yeah. But there's other things that we can do. So one thing that I've been doing also is that I've been saving micro 10-year data. I think that once I get a new drive, I might start saving all 3 of the treasuries that I got, or maybe all 4, maybe even the ZT2. And then we could be able to put them through a machine learning algorithm or something and see what kind of fun stuff we can do with it there. Keep it quiet, let them trade. No, Paul, I'm telling you. Here's the thing. Okay. Yeah. More people coming in, could be more competition. That could make it harder for you to trade, right? But there are so few people trading it here that those of us that are trading these and understand these instruments can only benefit from more people trading them, right? More participants is always a good thing for the market. Yeah. But it would be a good thing for us too. Like having this kind of liquidity that we have in the 10-year and all of the other instruments would be objectively better for everyone, right? It'd be good for everyone. And I really think that what the micro treasuries presents an opportunity that is way better suited for a small retail trader than what most people are trying to do. Like you're trying to do it with stocks, you got all of these problems with the pattern day trader rule and being over leveraged and stuff, and any of the other futures you tend to be over leveraged. But here in the micro treasuries, you're not risking very much. And like, even if you're not making money or you're bleeding commissions, or costs, because I mean there is the data costs. I wish we could bring the data costs down, but you're learning, and you can learn that way and not have to be spending a bundle on it for many years until you figure it out. You know, most people, you know, like especially if you're in cars, you spend more money than that in a year anyways. So it totally makes way more sense as a hobby to be trading micro 10-year futures rather than ES futures or whatever, right? So yeah, I want to promote that more. That's why I've made these videos that I did. Made one about reasons to trade the micro treasury yield futures, and here I made this video that I just linked you guys. I hope you go and watch at the end of the stream, how to trade Federal Reserve policy, where we talk about basically following the things that matter towards the Federal Reserve and the run up to the meeting and all of the little details about that. Okay. Last video that I think we're going to have is going to be about some of these things, like how interest rates and foreign exchange rates are related to each other, how the quantitative easing stuff works, that kind of a little bit more about like, here are the things that drive flows in the treasuries specifically, and pricing them and stuff. So a little bit more wonky of a video, but I haven't finished writing that one, so I'm still kind of working that one out. And like I said, there's some other stuff coming that I'm also really hyper excited about that we're going to make videos about as well. So the future looks bright, I think. We continue to see some opportunities here. But in the meantime, I need projects. I guess I have too many projects. I guess I should just say, hey, I did the investigation that I wanted. I understand something about the micro yields now that I didn't before. I should probably cut my losses there on that one. I've got other things to do. I need to put more time into these indicators I got from NinjaTrader for you guys. So I want to put a new version out, and I want to have a webinar about it. And you know, that could provide a lot of resources to put even more into the development and do some of the other really cool stuff that we really want to do, right? More networking / collaborating with fixed income retail trading would help too. Oh, well, yeah, I agree. But really what we need to be doing is we need to be able to collaborate with the real professionals. I've been working on that. I have found a couple of people on LinkedIn that are kind of more in that direction. Not too much. Not people that are too active, unfortunately. So I'm working on it. Like I was saying, there's this guy, Fed Guy 12 on Twitter, that used to be on the Federal Reserve, on the New York Fed's trading desk, was a senior trader over there. I'd really love to talk to that guy, but I don't have contact information for him. And I tweeted at him, but he didn't respond. So if any of you guys know this guy, Fed Guy 12, and you can get his attention so that we could get an interview with him, I'd really appreciate it. He has done interviews with other people, but we want to interview him specifically about trading interest rates. So we're getting to the point where most of the like serious information about trading that we've got out there, so I can kind of pivot a little bit more to more general content, which is what I think you're going to start seeing here in the fall now. Took maybe a month or two more than I wanted to on what I'm doing right now, but it's all working out in the end. Jacob, there you are. I was wondering where you went. This was all messaging me on Sunday night, but then I didn't see him this morning. I'm like, what the heck? Well, there were many points here today where I was like, oh, I really do kind of want to take a trade and go short the rates and all these sorts of things. But look, like it hasn't really, since that time, it hasn't really gone anywhere. So I'm actually quite happy that I didn't touch it. That was kind of one of those between the line areas where like maybe you could justify a trade and maybe not, but if you do justify a trade, I wouldn't be expecting more than 1 or 2 basis points on it. And I've kind of been leaning towards not trading those, and it's been working out well for me. So I think I'm going to continue to play cautious, and there's probably going to be a lot of that this next week. Although we'll see, because I didn't expect there to be as much activity here today as there was. But we're getting into a time period here where there's less data. We've got options expiration, but then like the kids are starting school up and everything. So this kind of tends to be one of the slower parts of the year. And then we've got the Jackson Hole. That's another one. If you I need the hookup. I get a lot of, I have to say, you guys, I have the best followers. Akshay is very, very knowledgeable. We've learned a lot from him. You guys clue me in on useful information all the time, and that's a big part of why this channel has been so valuable. But we need like the inside hookups. Like we need somebody that works at the Fed and can get us an invite to Jackson Hole, right? So if you know anybody that might be able to get us a press invite to Jackson Hole, I would love it. That's just a short little drive from here. I would love to go and watch speeches up there. Don't be cautious entering like when others. Oh yeah. Don't laugh at me, actually. I want to go. I don't even like this. The funny thing, like the thing that drives me crazy about that one is like, wow, I could just go down there. I wouldn't be able to go into anything. What would I do? Talk to people on the street. But it's very close to where I live, right? It's only like a 4-hour drive or something like that. I've been there many times. I don't remember why, but I've been there. Okay. Kind of want to go there again. It's a nice place. Bring your fishing pole. Ooh, you have a friend that's a CEO of a quant firm? That's cool. One of the things that I think we're kind of in an interesting spot is so for the quantitative finance guys, I want to be asking some question of some of these quant researchers. And I think I kind of know the questions that I want to ask, but those questions are kind of more about like what the future holds and what their opinions are on certain questions that we have and stuff like that, right? But there are some other people that we could talk to. Like if there was like the CEO of a well-known quant firm, aside from, okay, so what are the best things that you can do to try and get hired at a place like this? Especially because a lot of those places, they like to hire you out of school. And I think that most of my viewers, they're past that, so it's like, okay, I got these people that they really are really involved in markets and they're really engaged and they have a lot of knowledge around that. And they have technology knowledge that would be useful to you guys. So what is it that they got to do to get themselves on your radar? Because I think that these guys that you would really like to hire them, but when you go through the hiring process, I think most of you guys would get ignored, So I would ask them questions like that. But beyond that, I don't even know what I would ask him. I feel like that I know so little that I don't even know what to ask, you know? And on some things. But it's kind of always like that, right? There's just so much to know about the market. You're never gonna know it all. I just always kind of wonder, is there something that's like really pivotal that, like, you know, you probably shouldn't be participating in the market unless you know this thing that are maybe out there? I think that there might be some things like that going on in the treasury market from time to time that we don't know about. Let's work on that. Yes, let's work on. So all you guys get on LinkedIn, start developing your network over there, and try and get us in, you know, try and build contacts with professional traders. Ask him how many exchanges allow hiding and sliding. Oh man. You know what? Here's the other thing. It's about time for me to go, but you know, I made a TikTok/YouTube about this. I'll probably make more YouTube shorts this week because we talk about tools. But oh man, what we do, which is kind of more speculation, is like diverged dramatically in the last 10 years or so. They've kind of diverged. And so like what these top hedge funds and what these professionals are doing is like so different. You know, we could learn a lot from them, but almost everything that we would learn from them would be things that we wouldn't be able to put into practice directly. It may actually be the case that there are things that the pros could learn from us, that coming in and watching this, things that we've learned from a speculation perspective, because those guys don't have to worry about the speculative aspect of it as much anymore because they basically got rid of prop desk trading, right? Isn't that interesting? But it kind of really just kind of tells you how underdeveloped the art of speculation really is, in my opinion. So I think that there's still big discoveries for us to make, right? It's kind of like, well, we actually know more about this probably than any other public source on the internet. That doesn't mean that we're all super smart. It just means that's how much further we've got to go, because what we know is still very, very, very little. Very, very little in the larger scheme of things, and in the larger scheme of what there is available to know, right? Any suggestions for receiving live price alert text messages for futures market? Well, I think I could probably write something in NinjaTrader that would do that for you, because you can, there's some Google APIs that would allow you to send text messages to people. But something that's like all kind of like set up for you, I'm not so sure. Maybe if you were paying for TradingView so that you had the futures data on live futures data on TradingView, you might be able to do it on TradingView. Anyways, probably making some more videos about tools. Probably today is going to be Jigsaw, because somebody asked me a question on TikTok, and then we'll talk about spread charts and stuff. So keep an eye out for those. But really, I got this new video. I really think this is a useful video for beginners. I think that a lot of new people could come into trading treasuries from this video. So I would really appreciate it if you go over to that video, and because I know that you've all traded before. So I would like to know, what was your favorite memory from a Federal Reserve Day? Put that in the comments of that video. That will help that video out so much. So just put the link there. No, I still use NinjaTrader. I don't use them as my broker anymore, but I'm still using their charts. And I just use a demo, what do you call it? A demo license instead of my developer license, so that I can use Rhythmic without being on them. Which means that I can't use like their order flow tools and stuff, but that's okay because I got other stuff for that anyways. Ninja still has the best charts. That's the thing. They still have the best charts. I would love it if like Jigsaw had better charts, but right now they don't. Right now they don't. They're okay. They get the job done, but they're not as good as NinjaTraders. I would love to. Maybe I'll make my own trading platform. I kind of want to go make my own part. Like, so we're selling the indicators. If the indicators take off and really start getting, you know, a lot of income coming in, then what I'm going to do is I'm going to take all of that money and put it towards building my own platform, probably. All right, guys, I got to get going. I will see you guys tomorrow. In the meantime, stay